Hello and welcome to Budgeting and Organizing Your Finances. Creating a budget helps you to understand how much money you have, how much money you have to spend, and how much money you will need in the future. A budget can drive important business decisions like cutting down on unwanted expenses, increasing staff, or purchasing new equipment. If you end up with insufficient money, the budget can guide you with altering your business plan or prioritizing your spending on activities. In this module, you'll learn about the importance of the business budget and the components of a good budget. By the end of this module, you'll be able to explain the importance of a good budget, list the 8 steps of creating a business budget, describe ways to prepare yourself financially, and identify ways to organize your business finance. Why is the budget so important? It helps you from overspending, it keeps you on track of your goals, it lays the foundation for success, and it helps you prepare for the future. If you want to buy equipment, an auto, or really prepare for those unwanted challenges that occur in your business and also turning a profit. A business budget is a spending plan for your business based on income and expenses. It identifies your available capital, estimates your spending, and helps you predict the revenue. A budget can help you plan your business activities and also act as a yardstick for setting up financial goals. It can help you tackle both short-term obstacles and long-term planning. If you are starting a new business, the first budget you create might be a challenge, but it's also good to learn from this experience and a good way to understand what works best for your business. The best place to start in getting to know your budget components are the following. To really understand estimated revenue, fixed costs, variable costs, one-time costs, cash flow, and also profit. Initially, you might need to make several assumptions to get your budget started. A budget is really a roadmap for your business. It helps you predict cash flow, identify functional areas that are needed, and run your operations smoothly. Successful businesses invest a lot of time and effort into creating realistic budgets because they're an efficient way of tracking the extent in which business has to achieve its goals. Creating a budget can get a bit overwhelming for new businesses as there are no previous figures to guide their budget estimates. But with some estimates based on the performance of competitors and an understanding of components of a budget, you can complete your first budget and have a good roadmap for the future. A few of the top reasons why businesses fail include pricing and cost issues, losing focus, and running out of cash. These issues can be prevented by having a realistic budget in place. But before you can focus on a budget, however, you need to identify what aspects of your business you like to improve. This will allow you to decide what can be done with your funds. Based on the list, you can set up a short-term and long-term goals. These goals will be directly affected by your income and outcome or your expenses of your cash. A short-term goal can be paying off a debt or purchasing new equipment. A long-term goal might be keeping aside marketing expenses or critically more of saving for a rainy day. It also allows you to connect overall with the growth of your business. You should be practical about your goal setting. They should also be purely based on your business capacity to spend and save. Once you have your goals in place, you can create an effective, foolproof budget by following these steps, which are analyze your costs, negotiate costs with suppliers, estimate your revenue, know your gross profit margin, project cash flow, factor in seasonal and industry trends, set spending goals, and bringing it all together. We'll take a deeper dive on each one of these components next. Analyzing costs. Before you start drafting a budget, you must do some research about the operating costs involved in your business. Knowing the costs inside and out gives you the baseline knowledge needed to craft an effective spending plan. Your budget should be such that you can increase your revenue and profits enough as your business expands to handle your growing expenses. Your budget should factor in fixed, variable, and one-time and unexpected costs. Some examples of fixed costs are rent, mortgage, salary, internet, accounting services, and insurance. Examples of variable costs include cost of goods sold and commissions of labor. There is no such harm in overestimating the cost involved, since you will need enough cash to handle your future expenditures. If your business is new, then you must include startup costs as well. Planning the budget this way will help you to make informed decisions and tackle unwanted surprises with your finances. Second, negotiate costs with suppliers. This step will be very useful for a business which has been functioning for more than a year and are dependent on suppliers to sell products. Before you get started on your yearly budget, have a chat with your suppliers and try getting a discounted rate for materials, products, or services you need before you make your payments. Negotiations allows you to create a trustworthy relationship with your suppliers. This will be helpful when incoming cash is thin. For example, you might be in a seasonal business. When you have enough cash saved, you can pay in advance for those expenses you have incurred with that vendor. The main goal here is to find efficient and effective ways to reduce costs while doing business. Third, estimate your revenue. Many businesses failed in the past by overestimating revenue and borrowing more cash to meet operation expenses. This defeats the very purpose of creating a budget. To keep things realistic, it's a good idea to analyze previously recorded revenue. Let me say this again, previously recorded revenue. Businesses must track revenue periodically on a monthly, quarterly, and annual basis. Your previous year's revenue figures can act as a reference point for upcoming years. This will help you to set realistic goals for your team, leading to eventually growth for your business. Now, 4, know your gross profit margin. The gross profit margin is the cash you have left with your business has dealt with all expenses at the end of the year. So again, the gross profit margin is the cash you are left with after all your expenses are paid. It gives you an insight into the financial health of your business. Project cash flow. There are 2 components to cash flow: customer payments and vendor payments. You need to balance these 2 components to keep cash flowing in your organization. To do your best to ensure timely customer payments, it's important to have flexible payment terms and the ability to receive payments through common payment channels. Unfortunately, you will need to deal with customers who might not comply to the stated terms. This might affect your cash flow forecast due to missing payments. You can encourage payments by giving customers a grace period and creating strict business policies for late payments. When you know your incoming cash flow, you can fix an amount for your employee's salary and travel expenses. You can also allocate some money to pay off your fixed vendor expenses as well. If you are still left with cash, you can spend money on your business initiatives such as professional development or new equipment. Number 6, factor in seasonal and industry trends. It's unrealistic to expect that you will achieve every business goal and reach your estimates every month. In an annual cycle, there will be months where the business will be booming and there will be months where the sales are low. Due to seasonal inconsistencies in industry trends, you will have to spend cash effectively so that the business isn't at risk of shutting down during slower periods. To overcome these challenges while creating a budget, gather insights as to when your business performance is better. The aim should be to generate enough revenue during peak months to sustain the business during off-season. For an example, let's assume that you have a business that sells winter clothing. Your products are on demand during the season, so most of your revenue comes during that period of time. For the rest of the year, you can use the earnings to keep your business going and market to specific target groups like hikers or travelers. This will help you gauge how successful your products are during off-season, what revenues to expect, and how much to save during your peak period of time. Now, 7, set spending goals. Making a budget is more than just adding your costs and subtracting them from your earnings. How wisely you spend your money determines how well your business will fare. Goals provide a system to check if your money is being spent on the right areas to avoid unwanted expenses. For an example, if you're spending money on stationery, this is going unused for operational or marketing efforts. It may be time to cut those expenses. This money can be better used and applied to marketing campaigns, bringing more leads or revenue. Gauge the investment in certain expenses that will benefit your business in the long run. And last, bring it all together. Once you have gathered all of the information from the previous steps, it's now time to create a budget. After you subtract your fixed and variable costs from your income, you will get an idea of the amount that you can work with. Be prepared to tackle the unexpected one-time expenses that come your way. You can then find ways to use money effectively to achieve your short-term and long-term goals. Cash flow may be tight during early stage of business, but how do you prepare yourself financially? These are a few steps to keep in mind to prepare yourself financially. Limit new debt or monthly expenses. So be really aware what debt you are personally spending on your personal endeavors. 2, save as much money as you can. Find ways to save money, like couponing or shopping at discount stores. Number 3, get your personal finances in order. So just as important it is to create a budget for your business, get your finances in order means to really think about what you're spending and your income coming in, to make sure that you have all your revenue that can supply all of your expenses. Number 4, track all your expenses. This is a great way to save money as well when you write down all your expenses that you spend your money on. And 5, as talked about throughout this module, is budget. Budget by the month for your business. And lastly, take into account your personal budget and calculate how much you need to survive for at least 6 months. This will dictate how much money you spend and how much money you need to make to cover your personal finances. Now, how do you organize your small business finances? The most important thing to think about are these 6 steps. Track your income. So finding a system, a way to track how much money is coming into your business. Track and audit your expenses. So looking at your expenses, your bills, and making sure that you're paying them on time and you're paying the right people. Keep a separate bank account from your personal finances. So definitely have a separate business account. Protect your business. Register your business with your state and also federal government. This separates you from your business from future liabilities. Consider how you receive payment. So ensure there's a clear method, a way that your customers can pay you for your service or product. And also, most importantly, keep records. So keep a hard copy or digitize your receipts and also your statements to your customers. Now, let's pull it all together. In the next exercise, there's 3 steps. Schedule 1 hour with yourself where you will review the 8 steps that was previously mentioned into this module to create a business budget. Follow the steps on slides 7 and 8, steps 1 and 8, to create your own budget. And lastly, list some of the ways that you will prepare yourself financially for your business venture. I wish you all the best and good luck.